Right. I tell you, I haven't had such an attentive audience in a long time. I thought everyone would be enjoying coffee and you're all sitting down round to go. So we better make a start. Good to see you all this morning. Another active week, another active day in the market. So I'm sure you've got lots of things to think about and discuss. But I also hope that we will give you a lot of things to think about over the next hour or so. You know, against the daily barrage of negative retail news, and let's be clear, there is a lot of it, we felt it was right and pertinent that we get together and just give a little bit of a deep dive in terms of what we think really is going on out there, particularly in our centres in our market, because you know, retail is a very broad church. You see big headlines, a lot of them based on averages. We've maintained that not all retail is equal. However, you know, we are not immune from what is going on. It is a very tough market. Let me be absolutely clear. And today's presentation, we want to give you a sense of, you know, the good, the bad, and the ugly, if you like. But let's remember there is a lot of good in there. And we will, at the same time, make no apology for pointing out the positives, okay? But we recognise there are many negatives in there as well, and we're going to highlight those, steer you through, you know, what is happening in our centres. And in doing so, we'll be providing some additional disclosure. So I hope you find that helpful. Clearly, we're going to have time for questions at the end, where we can get into some of the detail. Now, overall, the next hour or so, I'm obviously going to give a bit of an intro and a bit of an update on the strategy update that we provided in July. Then we get on to Mark, and he's going to really give you some sort of in-depth view on the themes of what is happening out there in terms of the marketplace. As you know, Mark is our MD of our UK and Irish business. Then Ian will provide a deep dive into retailer rationale for taking space and just pointing out they really are taking space, still good demand for our stores. And then we'll come back to Mark, really just looking at what the consumer's thinking at the moment and why they are craving experiences and still coming in their hordes to our exciting venues. Then some of you are going up to Bullring to see some of this in action later on. So Mark is just going to give you a little flavour of what you are likely to expect and see later this morning. And as I say, we'll wrap up with Q&A at the end. We also have a number of Hammerson colleagues here, so whether they form part of the Q&A formally or you just hang around afterwards and have a conversation, please make use of that opportunity. So, now before I take you through our progress on our Reshape strategy, I want to give you my take on UK retail and how we're faring. The team will build up many of these themes later in the presentation. So, as I said at the outset, the market is tough. The challenging sales and footfall stats show this, even though we are outperforming the market. More concerning, perhaps, is the raft of CVAs and the challenges of department stores, and they are impacting our NRI to the tune, we estimate, for this year of around £7 million. That is slightly higher than we previously guided, but we think that is the measure of it for this year. Now, we've dealt with this sort of brutal CVA process before. Around 2012, there's a real peak in CVAs and then further wave in 2014 with a mass of retail brands disappearing from the high street. However, I have to admit it does feel even tougher right now. Not least because our previously much loved department stores have perhaps not acted quickly enough to adapt their models. And it's certainly more challenging for the industry to re-let this scale of space than it would have been in the past. So in this demanding environment, both retailers and retail destinations need to be on top of their game. Retailer brands need to control costs and make wise investment decisions, of course, but they also need to promote their brands. Stores are a vital part of this mix, but they don't need as many of them. That is clear. Fewer units. And because we're focused on delivering excellent dynamic destinations, brands are talking to us at the expense, I would say, of other locations. And this, as Ian will set out and Mark will set out later, is delivering very positive leasing volumes. They're up 23% year on year. And if those of you who are attentive and look back, last year was a record level of leasing in our business. So we have record levels of demand for space, notwithstanding the very difficult environment we're in. Now, bold decisions have helped drive this performance, like the reconfiguration of House of Fraser at Highcross, and we'll give a little bit more detail on that and the implications for the remainder of our portfolio. But owning destinations where brands thrive is key to delivering against our disposal strategy, as supported by the recent transaction with our 50% disposal of Highcross, which means we're now close to 90% of our 2018 target, and we're confident of reaching that target for the year. In today's environment, we're experiencing, no doubt, the cyclical challenges I've mentioned, and both shoppers and retailers are weighed down by a number of factors, including, of course, Brexit and the limited wage growth that we've seen, although that looks like we're starting to see some green shoots of recovery there. And these are compounded by key structural pressures. You know what I'm talking about here, most fundamentally the growth of online and fairly fundamental changes in shopper desires. However, I'm both a realist and a pragmatist about the tough conditions we face. I'm also confident that by leveraging our flagship winning destinations of the highest quality, we will deliver on all elements of our revised strategy. So, as Tom and I set out in July, our reshaped strategy creates a more focused portfolio on winning destinations. We will only own assets of the very highest quality that we believe will be relevant and outperform in this changing retail environment. This is designed to balance delivery over the short, medium and long term. As a reminder, the three pillars of our reshaped strategy are an optimised portfolio, operational excellence and capital efficiency. So let's look at the progress we've made since we made our announcement in July. Firstly, the optimised portfolio. As you're aware, we announced a couple of weeks ago, as I've said, the 50% sale of Highcross, and this does bring us up to the 90% level of our 2018 target. And I'll give a little bit more colour of what I think are the implications of that disposal and pricing on valuations for our portfolio. Recent disposals now mean 45% of our assets are non-UK as we continue to strive for greater European diversity. On operational excellence, we stated our desire to reduce our reliance on undifferentiated department stores. We already know this makes both financial sense, we've seen that in Leicester, and can improve the performance of our centres by bringing in must-have brands for shoppers. We're in live discussions with operators on continuing shift of this mix. Now, on our ambition to reduce costs by at least £7 million per annum, I'm pleased to say we have already secured savings of £5 million per annum and are very confident of hitting that £7 million. And on capital efficiency, we are well underway with our share buyback programme, having already completed the purchase of 16.5 million shares, taking advantage of the disconnect between our share price and NAV. Finally, proceeds from disposals are contributing towards a reduction of debt with pro forma levels of around £200 million lower. Now, returning to Highcross. This was a undoubtedly complicated and time-consuming deal, but the transaction has, I think, a far greater significance than our previous disposals. To attract a major international investor who is new to our JV lineup is a big vote of confidence in a market which I've said we all agree is tough. It's a vote of confidence in both the quality of our assets, our operational excellence, and for investment in UK retail property. And as you can see from the chart on this slide, there has been falling transactional evidence and virtually none of the scale of Highcross in the year. 2018 has undoubtedly been a year of assets coming to the market almost in a private sense, but then being withdrawn after weak interest. Getting deals over the line in this market requires a matter of determination and patience from the team and executional excellence, which we have shown. We've delivered a significant amount of investment activity this year through the disposal of 4 retail parks and Highcross, and are now close to reaching our stretch 2018 target, as I've said. Interestingly, our activity alone makes up over 20% of the UK shopping centre and retail park disposals this year, so no small feat. Now, future ERV growth is still obtainable. We will set out how tenant demand remains strong, rental levels healthy in most cases, which are augmented by events, digital enhancements, commercialisation, and more recently our city quarters concept. More of all that later, but I believe that the asset valuations are rational, and this is backed up by the Highcross transaction. Now, some people might interpret the 5.5% initial yield for Highcross as an automatic read across for our entire portfolio. This is not the case. As you can see from the chart on the left, there continues to be a spread of yields based on the market's perception of quality and performance, with the best shopping centres continuing to attract lower yields and secondary centres seeing an outward shift. And I describe the best shopping centres as those that are performing in footfall, performing in sales, and importantly, performing in terms of ERV growth. The yield differential shown is consistent with recent operational metrics shown in the table on the right. Bullring has outperformed both Highcross and the wider markets in terms of both footfall, ERV growth, and catchment strength, and therefore I think rationally you would expect this to warrant a lower yield. Now, despite the lack of transactional evidence, we strongly believe that this yield differentiation continues to exist, with both brands and international investors drawn to flagship, well-managed, high-footfall destinations. Now, this slide might look familiar to some of you, as we've previously shown the quality of the group portfolio. Now, this looks solely at UK flagship destinations, and you can see it makes a pretty impressive report card. And I think this is the best scorecard in the UK, indeed Europe. Half our venues are the highest possible quality rating, and all of our assets are classified as A- as a minimum grade quality. This undoubtedly reinforces that we have a great portfolio with market-leading assets. It's a portfolio we can further enhance to adapt to the changing retail environment, and it's attractive to global capital. Mark will now look into this in more detail. Thanks.
Thank you, David, and good morning. So this slide highlights the combination of the cyclical challenges and structural shifts that are driving the accelerated polarisation in the retail landscape. The cyclical challenges are well documented. Brexit uncertainty, squeezed retailer margins, and stretched consumer are contributing to a spike in retailer failures and restructuring. More specifically, the majority of retailers, including department stores, have suffered significant increases in business rates, and price deflation is undermining profitability. And I'll look more closely at retail failures shortly. Further structural shifts are contributing to this Darwinian evolution of the retail landscape. Increased online penetration and shift in spending patterns, with a growth of 17% in leisure spend over the past 5 years. These are driving the polarisation of our retail venues. In this landscape, Insight tells us that urban flagship destinations will continue to outperform. These destinations are important for brands to sell their goods, promote their brand, and for shoppers to meet, socialise and enjoy. It's the big day out. Now, as David's highlighted, the trading environment remains turbulent. The cyclical economic pressures are undoubtedly have an impact on shopper wallets. And you can see in the top left-hand box, Hammerson's store sales are down 2.7% year to date, albeit marginally outperforming the index by 10%. Non-price food deflation of 1.5% over the past 12 months is, as I've said, impacting on those numbers, with clothing and footwear a brutal minus 6.5%. Now, I should emphasise these are store sales figures. They don't include the online halo effect, and we've explained in previous updates, Insight suggests that store sales typically understate performance by an average of 15%. But it's not about averages. Look behind the portfolio headlines and you'll see contrasting categories as shown in the bar chart, with the grey line for each indicating the range within each sales performance. Experience continues to perform, with leisure operators seizing on the shopper's desire to do things. And department store performance is by no means unilaterally poor, as you might conclude from recent headlines. It's in fact polarised, and I'll provide more colour on this shortly. Selfridges and Harvey Nichols, which are houses of aspiration and luxury, are outperforming. For those sectors underperforming, we need to bear in mind the tyranny of averages. Although health and beauty as a category is underperforming, those that sell products and services like Sear Beauty, Barber, they continue to outperform. Undifferentiated F&B brands are pulling the sales index for that category downwards, but those that create the true point of difference and the modern mix of healthy foods, they outperform, like Leon and Wagamama, alongside other brands that are outperforming in the bottom left-hand side. Of course, fashion continues to be hit hard in the mid-market. So the underlying theme is that those businesses offering clear brand purpose with a strong customer proposition and excellent operational delivery continue to report positive store sales. Our job is to identify the winners and proactively address the less relevant occupiers, and hence our strategy to deliver a step change in the retailer lineup. And Ian will look more closely at this shortly. A word on footfall, down 2.1%. Now we'd clearly like to see this number increase, but there are two positives here. Firstly, we're outperforming the index, and secondly, we think that the quality of the shopper is improving. They're spending longer, coming back to us more frequently, and I'll explain what's driving this trend in the experiences section later in the presentation. So now a focus on CVAs. The prevalence of CVAs and administration so far this year has been well documented. As David said earlier, you can see the increase relative to 2017 in the left-hand graph. And the brands affected predominantly in fashion and mid-market F&B, as highlighted in the bottom right. So we currently have 71 units impacted by the current and the current rental exposure from those operators is £8.6 million. We expect NRA impact from those failing retailers, again, as David's highlighted, to be 7 million in 2018, 1.8% of group passing rent. And now, amongst all this, it's reassuring to note that occupancy is holding up. 71 of those 71 units, 53 continue to trade, and this really does reflect the relative strength of our schemes in the increasing polarisation of venues to which I referred earlier. It's also encouraging to note that rental payment collection rates remain robust, with over 97% of our rent collected within 7 days of its due date, and there's a graph in the appendix which details this. Now, whilst retail failure is clearly unwelcome in the short term and has a negative impact on like-for-like net rental income, it does provide the opportunity for us to refresh the brand mix and deliver our strategic pledge to rotate occupiers. So this slide highlights some of our F&B successes. Now, exciting F&B formats drive footfall. I mean, people are taking photographs of their food. They're Instagramming it to their pals. Who'd have saw that coming 5 or 10 years ago? And in fact, there's a recent study, it's an Italian one, so you might want to bear that in mind, that says that pizzas are now the most Instagrammed food item. And I think as far as my family is concerned, that probably holds up. And all this is part of the theatre and excitement that's being offered by contemporary restaurateurs. And with our expert F&B leasing team, we've had some successes in introducing these brands into the CVA challenged units. So brands such as Holy Moly Macaroni highlight the ability to move rents on. And whilst Union Square and High Cross, we've taken a rent reduction in order to secure 2 excellent brands in Mod Pizza and Brewdog, who will widen our customer base. In fact, for Brewdog, that's their first unit taken in a shopping centre. So now a word on department stores. As we've emphasised, not all retail is equal, and that includes this sector. So this slide highlights the diverging performance of our department stores with positive sales growth from those more aspirational operators, as I detailed earlier. Now, I should point out that these sales trends highlight the Hammerson in-store performance. They don't take account of the online halo. John Lewis recently reported that 42% of its sales are now online, and with global data estimating that the true value of John Lewis store sales is 52% higher than the actual sales reported through the store. Now, to put this slide into context, we've 21 department stores alongside 1,000 retailers across our 11 UK centres. They cover 3.4 million square feet, occupying almost 40% of our space, but they contribute just 8% of the rent. So what are we doing about the underperformers? Well, we're actively working with Debenhams to right-size and update their portfolio with us. Last year, we introduced 2 F&B operators, Real Greek and Franca Manca, to their Reading store, and they've just completed a very attractive store upgrade in Leicester, to which customers we see are already responding. Taking House of Fraser, we're working up options following their administration, and demand for this prime space is encouraging. We're targeting conversion and repurposing of these stores by H1 2020. With an average rent of £10 a square foot across our department stores compared to the up to £50 per square foot achieved by consumer brands, we see good scope for rental value uplift following these conversions, albeit this will result in further downward pressure on like-for-like NRI in 2019. Now, to illustrate the department store point, here's a recap on what we've delivered in Leicester in the former House of Fraser. This was significant space in the centre, occupying 117,000 square feet over 3 floors in prime position. And I'm pleased to say this project's nearing completion. It's a fabulous Zara store, the largest single-floor Zara outside of London. In fact, in the UK, opened last month. JD will also open what promises to be a stunning new flagship, and our adventure golf offer and new restaurants are scheduled to open early next year. In addition to the massive improvement in the customer offer, the project will deliver an additional 1.5 million of income for a 17 million project cost. And that's very much our strategy to reduce department store space by 25% in action. Now, insightful and energetic leasing goes to the heart of what we do here, so I'm delighted to hand over to Ian Mitchell, Commercial Director, who will give you some leasing commentary. Ian.
Thanks, Mark. Effectively, as both David and Mark said, this is a really tough market. And trust me, being head of leasing, I know only too well about all of that. I think that the one thing that stands to our advantage is that we have great assets and that we're delivering great leasing, as I'll come on to in a second. One of our core strengths is that we have an absolutely fantastic and dedicated leasing team. These teams are specialists in what they do. They concentrate on retail and they concentrate on F&B. They know these operators absolutely inside out. They build up relationships, they get intelligence, they understand where these brands are moving and in what direction that they're going to take it. And that is absolutely vital for us when we are going to look to expand with them in partnership with them going forward. I always give a few anecdotes about recent conversations that I've had, and I will give you a few of those. So this week I was with the CEO of Putt-Shack, who have opened at White City and soon to open in Poultry. I don't know how many of you are familiar with it, but it's a great concept. It is crazy golf with a luxury bar right in the middle of it. I can't think of a better concept. You know, these guys are taking 20, 30,000 square feet. I was with River Island, the property director, and they were rolling out new product, and it's interesting to hear direct from these people exactly what they are doing. I've had conversations this week with Zara, with H&M, with Moss Bros, with Mamas and Papas, and that's just in the last few days. So, you know, our team are absolutely connected with the retail market and understand what is going on. And for us, that is absolutely vital in shaping the way we lease going forward. Leasing volumes, as David mentioned, we're up 23% on where we were this time last year. And you'll see in the top right-hand side the stats in terms of against ERV, against passing rent, and in terms of the average lease length and the incentive. Now, in terms of the incentive, you'll see that that is actually slightly less than last year, and that has come down to the current level that you see there of 8 months. Also, in terms of lease renewals, that number is considerably less than that, where a retailer is just renewing on an existing basis. I think the backdrop to all of this is that this isn't about store closures. This isn't about them rationalising their portfolio in our estate. This is about optimising store sales, and this is about ensuring that they have got a portfolio that is fit for purpose going forward. In terms of demand that is driving this, we're seeing good demand in that 2,000 to 5,000 square foot size bracket, with particular emphasis on cosmetics, accessories, electronic brands, and equally new entrants to the market as well. We're able to deliver this leasing strategy by doing a granular unit-by-unit review, which allows us to look at retailer performance and analysis, and that allows us to start and shift that mix to these growing categories that Mark referred to earlier. This slide looks at the leasing and the quality of the brands that we've leased to in 2018 year to date. I've categorised this into 4 main areas across our UK portfolio: fashion and footwear, personal luxuries, international brands, and F&B and leisure. I'm going to give you some examples of where we've done that, and for those who are on the trip to Birmingham later today, you'll see a number of firsts, not only to the Hammerson portfolio, but also in terms of brands reaching out beyond the Greater London. So for example, in Bullring, Hugo Boss have just launched a new concept. This will be the first store outside of London that they'll do in the Birmingham estate. In addition to that, you'll see brands like Morphe fitting out. Morphe, again, first one outside of London. In addition, Barbour, Arcot, NYX, cosmetic brands. So again, that is demonstrating that we have the quality of the assets, and in addition to that, that the retail demand is out there for the right product. Other examples that we've got, whether it be at Cabot Circus, Grand Central, Oracle, there are numerous examples where these brands are expanding. Brent Cross, we've recently done Mango and Guess, 2 excellent brands to add to the existing lineup. West Quay has seen a repositioning of its mix, and again, attracting those aspirational fashion brands such as Tommy Hilfiger and Hugo Boss. Mark's touched on F&B, but I think just to highlight on that, there is a shift in the F&B to more regional and more street food operators. And Mark gave the example of Holy Moly Macaroni. I will never give up, and I love saying that, so you'll probably say that about 4 times. But they are a regional operator that started out in Digpeth street food market. And they are amazing on social media. They're on Instagram, I follow them on Instagram, and they absolutely connect with their audience. Well, they certainly connect with me. But, and in addition to that, brands like Tasty Place, again a regional operator, that are coming in to refresh and replace those F&B brands that may have exited as a result of the CVA process or administration. So we're seeing a shift in the demand for F&B to those more regional operators to backfill those other offers. Brands are still investing heavily in stores. And why are they doing this? This is all about customer experience. This is about delivering an experience for the shopper and also to ensure to showcase the brand. Here's a few examples that I've got up here. Grand Central, again, I'm going to say Holy Moly Macaroni at Grand Central. And even as department stores, the luxury end, you'll see that Gucci have invested significantly in their Selfridges store to deliver that standalone. I'll touch upon the Ivy in Leeds later on, but again, that's just recently opened in our Victoria estate, and NYX in the top right-hand side. So I think it's no longer about simply selling stuff in these stores. There's a whole variety of reasons that the store performs. One is entertaining. You know, I recently was in New York, and if you go to the Adidas on Fifth Avenue, you go into the ground floor level, there's no product. It's about experience, it's about immersing you in that brand and getting you hooked on that idea. Next one is the curator. These are targeted at customers who carefully select products and make it easy for customers to find what they're looking for. There's then the deliverer. So the deliverer is somebody like Argos, who is flexible with its fulfillment and has a highly efficient supply chain. And ultimately, showrooming. So showrooming is about brands going direct to consumers. Increasingly, they want to control that customer experience, and the strongest way to do that is face-to-face. And we've got some great examples of where we're doing that across our portfolio. Now, those of you who were on the investor visit to Southampton last year, you all know that this is I call it my swingometer. So this basically will demonstrate the number of leases that we have completed to date. And as you'll see, the headline is that 80% of the leases signed year to date are at or above ERV. So the chart on the left-hand side is those below, and then as you progress to the right-hand side, those that are above ERV. You will see that the average is 4.5% above ERV. Now, a word on ERV growth. I think we often get asked the question, you're delivering record leasing volumes. You're letting units at or above ERV, so why are you not delivering ERV growth? Let me just give a bit of context and try and explain that. As you will see, 80% of the leases signed year to date are at or above that ERV level. The remainder, about 15%, are actually pop-ups or temporary lets. So why do we do pop-ups and temporary lets? We do those to ensure that we trial new brands, because that gives the operator a chance to understand whether there's a correct market for them, and equally for us, because we want to invest in successful brands. To maintain a vibrant environment, to ensure that we, to use my phrase, refresh and delight for the shoppers and customers. It's also for pure players, to give them a chance to transform from the digital world into the physical world. And when you, again, sorry for those who are not going to Birmingham, I wish you all were, but if you go to Link Street, you'll see some great examples of that conversion between the two. So those are the main reasons why we do those. The other overriding one is around reconfigurations. So in terms of reconfigurations, we will, on many occasions, as a stopgap, put in a temporary let. while we work up plans for the reconfiguration to enlarge, to split the space. So as a result, our valuers consider all these permanent leasing above ERV balanced against those temporary lets or pop-ups that we do. Broadly speaking, they have concluded that the ERV movement in the UK shopping centres therefore has been broadly flat. Clearly there is a bit of pressure on MSUs and the high street fashion, and we're seeing that as a result of the sales performance. So hopefully that gives you a little bit of context around ERVs and ERVs growth. In terms of what Mark talked about in terms of the proactive tenant rotation, I just wanted to reflect on some of the deals that I talked about last year, and also the fact that they have now come to fruition and are now all trading. Mark's given the example of Zara, and I've given you an indication of how well they're trading. In terms of Oracle, you may recall that we talked about the reconfiguration of space for Next and for River Island. River Island opened 2 weeks ago and already is trading above budget. And I have to say, in the fast high street fashion sector, that's no mean feat at the moment. In terms of Next, it will open in 4 weeks' time. Both those brands have chosen to relocate from the existing high street into the shopping centre, which is strengthening the retail offer, allowing us to rotate and refresh the retail mix on the back of those lettings. In terms of Leeds, the Ivy, that opened 3 weeks ago. Again, I shouldn't tell you this, but I will. They're doing in excess of a six-figure sum on a weekly sales basis. Don't try and book before Christmas because you won't get in. As a direct result of that, we've seen footfall increase between Victoria Gate and Victoria Quarter between 4 and 15% in the last 3 weeks. So this shows you about this repositioning, about the reconfiguration. While it does take a little bit of time to deliver, we have the skills, we have the teams to do it, we have the brands wanting space in our shopping centres, and ultimately, there's just a couple of examples of how we're delivering that. In terms of key takeaways for me, I think this repurposing, you can see that we're taking underutilised space, reconfiguring and reletting to brands that we believe that we want to partnership with and invest in the future. Let me be clear, as I said at the start, it is a tough market out there, but quality is vital for retailers, and we're in the fortunate position that we have those quality destinations that those retailers want to invest in. And despite all these headwinds, we are continuing to deliver key brand lettings and addressing our strategic objectives. Thank you, and I'm going to hand back to Mark.
Thanks, Ian. Who'd have thought that the Scotsman would get so excited about mac and cheese? Lived on it. So now, our flagship destinations, they provide so much more than just a place to shop. In addition to great brand showrooms, places to meet, eat with your pals, photograph your food, show it off on Instagram, we're actively investing in events to delight and connect with our shoppers. This picture of Wimbledon at West Quay perfectly, I think, captures that point. We made a strategic pledge to devoting more resource and experience to enhancing events and digital. And with this in mind, we've delivered a super events programme at West Quay. So what are super events? Well, they're spectacular large-scale events that attract audiences beyond the normal catchment. At West Quay Plaza, that's meant ice skating, a real maze, music in the city, art installations, and Chinese New Year, in addition to Wimbledon. High-quality, unique experiences, they turn our centres into entertainment venues. And you can see from the chart, the pilot delivers more feet and more eyes in front of our retailers. We're planning to roll out these events further with an annual investment of £5 million by 2021, funded by a combination of commercialisation, sponsorship, tenant service charge and landlord contribution. Now, digital is supporting retailer and driving the consumer relationships. It's core to our strategy, and we've got an engaging platform that's driving positive shopper behaviour. And there's some great stuff on this slide. I'm just going to point out a couple of key points. Firstly, Style Seeker. You've seen this before. Visual search inspiration tool powered by AI has delivered nearly a 250,000 product views this year, and thereby supporting retailers and driving sales. We have a shop online portal at Bullring, and that's effectively an affiliate link between our own online platform and direct to retailers' sites. And in Birmingham, it's driven 2 million of additional sales over the past 6 months, and we're now about to roll out that across the portfolio. And we continue to invest in new communication channels like customer services chatbot, which in Birmingham recognises the Brummie dialect, believe it or not. And that's provided 24/7 help and advice to over 20,000 users since launch, whilst reducing pressure on our customer service team. So those of you who got a Brummie dialect can try that out this afternoon. Now to city quarters and the concept which we introduced in our reshaped strategy in July. Now, as I said earlier, it's more than just shopping, and this concept is key to evolving our destinations beyond pure retail. By 2030, 78% of European population will live in cities, and so we intend to leverage our existing land bank of 70 acres in major European cities to create schemes with a complementary mix of uses, including residential, workspace, retail and leisure, with the aim of delivering additional value and income streams. These sites generally sit alongside our flagship retail destinations. They're served by excellent urban infrastructure and then provide a strong potential for us to develop interconnected, if you like, urban ecosystems. Now, let's look at this potential in a little more detail. As you can see, our existing land bank has a huge range of opportunities, 6 principal UK locations, and at all 3 of our Irish venues. And these have been extensively reviewed to understand each site's future potential. Over the next 12 to 18 months, our focus is moving these opportunities forward through planning stages with relatively low workup costs. And each city quarter opportunity will be reviewed to determine the extent to which we will develop and operate these different elements ourselves, or whether we work with like-minded partners to provide investment and relevant expertise. So, finally, for those joining us in Birmingham today, you're in for a real treat, a visit to our flagship Bullring estate. You'll be led by Emma Robinson, who oversees the Bullring team. So I'm going to give you a few slides just to give some colour and flavour ahead of that event. Now, as you can see, Bullring estate delivers significant scale and then some. 3.37 million visitors a year, a significant critical mass of retail, and future solid growth potential with a young urban demographic in one of the UK's largest and most affluent catchments. With plenty of initiatives on the go. These include major public realm works to enhance linkages between Bullring and Grand Central, and they'll also deliver major event space for the estate, giving us the opportunity to introduce the type of initiatives I talked about earlier. And this is in addition to upgrading of the main retail entrances to deliver an even better shopping environment and ease permeability around the wider city. The UK's second city is going places, and here you can see the wider growth drivers for our holding. HS2 will create an additional major transport hub, neighbouring the Martineau Gallery site, which we are master at planning around a transformational mix of office, residential, leisure and retail. Adjacent to Grand Central is Ladywood House, where we'll see a tired office block regenerated into a new breed of office space with active leisure and retail connecting through to Grand Central, delivering, and this is an important point, delivering additional daily footfall and spend to our asset. Birmingham's a compact city centre and it's got excellent retail provision, the bulk of which Hammerson are proud to have delivered. Bullring has just celebrated its 15th birthday. And these city quarter initiatives provide further scope for us to enhance and grow the sustainability and vibrancy of our key flagship asset. So I think you're going to enjoy the tour. So that ends this section of the presentation. I think we're going to move over to Q&A now.
Great, thank you. Thank you very much, Mark.